because Bitcoin is the best performing asset ever, to respond to money debasement. You go back to World War II, and if you think about around the world, where could you have invested your fiat dollars or euros or whatever currency if you wanted to escape, right? If you think about the United States, gold was illegal, couldn't buy gold. You could only buy stocks, S&P 500 or whatever the stocks were at the time. If you were in Europe, you were probably blown up, couldn't buy anything, or the Germans were taking your gold. If you're in the UK, gold was banned, couldn't buy gold. Stock market was a piece of shit because they were getting bombed, so you couldn't do that. If you're in Asia, the Japanese were taking all your shit, so you didn't have anything either. So, we don't have an analog to what we could have bought back in World War II because there just weren't that many assets. But today, we have a stock market globally, relevant countries. You have gold. It's a bit clunky, but you can still buy it. And you have Bitcoin.
If you think this is a bull market, Arthur Hayes says the answer depends entirely on when you bought Bitcoin. For the early crowd, those who stepped in during 2013, 2015, or even as recently as 2020, the gains are extraordinary. Bitcoin has trounced gold, stocks, and real estate by a wide margin. But for anyone who bought closer to $95,000 or $100,000 earlier this year, the feeling is different. Yes, it's up more than 100%, but expectations were for an explosive, runaway trade, not a grind higher. Hayes frames Bitcoin in the context of history. Since the 2008 financial crisis, it has been the best performing asset in a world defined by money debasement. He points out that if you go back to World War II, people didn't have this kind of option. Gold was banned in the US and UK. Europe was shattered. Asia was under Japanese occupation. Stocks weren't an effective hedge. Today, though, investors can choose between stocks, gold, and Bitcoin. And over the past decade and a half, Bitcoin has been the clear winner. Sometimes, Hayes says, the only strategy is patience. When pressed on the macro outlook, Hayes leans on a simple assumption: governments will print. That's the path of least resistance. It preserves the system, avoids battles with entrenched wealth, and allows society to stumble forward through the uncertainty of the AI-driven transition. If you found value in this breakdown, please hit the like button, subscribe, and share it with other investors who are paying attention. We're here to keep bringing you sharp analysis and voices that actually understand what's unfolding. Thanks for watching.
I think it really depends on when you bought your Bitcoin in terms of whether you think this is a bull market or not, right? If you bought a bunch of Bitcoin in 2015, 2013, even 2020, you're like, yeah, this is great. It's a bull market. Bitcoin, it's outperformed gold. It's outperformed stocks. It's outperformed real estate. But if you're like, oh, wow, they were printing more money starting in March this year or April, and I bought Bitcoin at 95 or 100 or whatever $1,000, and it's only up 10-15%, and I feel like a jackass because I was supposed to be the best performing asset. Well, wait a bit. So I think the premise of that question is a bit flawed because Bitcoin is the best performing asset ever, to respond to money debasement. You go back to World War II, and if you think about around the world, where could you have invested your fiat dollars or euros or whatever currency if you wanted to escape, right? If you think about the United States, gold was illegal, couldn't buy gold. You could only buy stocks, S&P 500 or whatever the stocks were at the time. If you were in Europe, you were probably blown up, couldn't buy anything, or the Germans were taking your gold. If you're in the UK, gold was banned, couldn't buy gold. Stock market was a piece of shit because they were getting bombed, so you couldn't do that. If you're in Asia, the Japanese were taking all your shit, so you didn't have anything either. So, we don't have an analog to what we could have bought back in World War II because there just weren't that many assets. But today, we have a stock market globally, relevant countries. You have gold. It's a bit clunky, but you can still buy it. And you have Bitcoin. And we've seen what's happened since 2008 in terms of the price performance of Bitcoin, gold, and stocks. And they've done very, very well, Bitcoin being the best. So I think that you just have to wait a bit. I think that's a political choice in terms of what are we going to share as humans, right? So imagine that AI was as effective as Sam Altman says it is. It is not, obviously. And all of a sudden, 90% of the jobs are gone. And oh, great. Wow, everyone's super productive. We can go and just, I don't know, jack off all day, whatever the fuck you're going to do. But you had this thing called a mortgage and a car payment, and you had this thing called rent, and you don't have a job anymore. And so the question is, okay, well, is the government going to mandate that private profits must go to the populace because now everyone's so productive? But then the people who own those companies are, well, hold on a second. I'm Facebook. I just dropped fucking $1 trillion in CapEx. I want my fucking returns. Why am I now giving universal basic income to all these motherfuckers who weren't investing while this AI thing was happening. I don't want to share. So then, okay, well, then what are you going to do about that? Are you going to just take away private profits and distribute them to people? I don't know. Again, that's a political question depending on where you're based. Or you were fortunate enough to have financial assets and you invested in crypto or AI or whatever, and you've done very, very well. And then there's all these people who weren't, in your case, you believe you're smarter than them or better than them because you have more money, whether or not that's true. Are you going to share? Oh, let's put a 99% tax rate on all capital gains and dividends so that everyone else can share in this amazing AI revolution and productivity boom. Do you want to share? Probably not. And so I think then the question is, okay, well, it's going to be very difficult for the government to politically expropriate assets from those who are in power already to essentially allow everyone to live this utopian lifestyle because of AI. Then what do? You just print a fuck ton of money and hand everybody out and then keep the capital structure the same. And so either you have a massive deflationary event and asset holders are completely wiped out, or you have a massive inflationary event which continues the same social structure, but then the asset holders feel like they've gotten something out of a return for their prescient investing behavior. Again, a political choice. I don't know. But if I had to bet, I bet on the government not wanting to rock the boat, and they're just going to print the money to paper over this big boom, and then maybe we decide to share as humans in this AI and this new ecosystem. So it could be a completely, risk-off event, which everything's worth zero, or it could be a risk-on event where everything's worth infinity, and I don't know what that is.
Arthur Hayes says the U.S. has every incentive to spread dollars more widely, both inside its borders and across the globe. In many countries, ordinary people would rather hold dollars than their weakening local currencies, but regulators block them from opening dollar accounts. That's where stablecoins come in. Delivered through big tech platforms and apps people already use, they're a backdoor way to dollarize the global south without requiring permission from local governments. The technical part isn't the challenge. Launching a stablecoin is straightforward. What really matters is distribution. Without an existing network, whether that's a massive social media platform, a global exchange, or a multinational company with millions of customers, you don't stand a chance. Building that reach from scratch would take years and enormous spending, and even then, you'd still be a decade behind incumbents like Tether and Circle. Most new issuers, Hayes argues, will eventually fade out. The same logic applies to so-called local currency stablecoins. People don't want peso or baht tokens, they want dollars. And in advanced markets like Korea, Japan, Singapore, and Hong Kong, domestic banking already offers instant transfers and QR payments. Local stablecoins add nothing. The demand is for dollars, plain and simple. Let's get back to the interview.
Obviously, we love DeFi at Maelstrom, and if you look at our portfolio, our best performing things, Athena, stablecoins, DeFi. I wrote asked you before, this one was about stablecoins and how I believe that this is the policy of the American empire to try to force dollars around the world, and that's going to benefit the DeFi ecosystem because you're going to onboard, millions or billions of people to using these tokens to represent whether it's a fiat currency or it's a bond or it's a bank deposit, what have you. And so we're super bullish on all things DeFi in the medium and the longer term, but obviously there are some short-term hiccups that, relevant projects could not do so well in the short term, but in the long term, we're very positive on that kind of stuff. So, obviously, I think that this is the policy of the U.S. government to get dollars out to a lot more people, whether it's the Eurodollar market or it's ordinary folks who are not in America who'd rather want to have a dollar bank account, but their regulators, for obvious reasons, don't want them to have a dollar bank account, and they're going to use the big tech platforms as their sort of attack mechanism and stablecoins as a way to dollarize the global south. But in terms of the technology, it's not that difficult. I think that most of these projects are zeros in terms of these new stablecoin projects, because if you don't have a distribution arm, you don't have a social media company, you don't have a large exchange, you don't have a large sort of MNC, multinational, FMCG business that has lots of clients, you got to spend to get those clients. You have to spend for that network effect, and you're 10 years behind the curve of Tether and Circle and Athena and all these other guys. So then how are you going to get enough money for that? So I think I would never invest in a new stablecoin issuer who doesn't have one of these distribution modes. I think a lot of these local currency stablecoins are zeros as well, because at the end of the day, the clients in these markets want a dollar bank account. That's what they want. Korea, Japan, Hong Kong, Singapore, all these Asian countries, domestic banking is very good. You can instantly send people money as long as you have a bank account. You can, scan QR code. It's not that bad, right? You don't need a stable coin. So why would I spend more money in some way, shape, or form to, subsidize the stablecoin issuer building up a network? So I think those are zeros as well. I think the real things that might be investable are, how do you allow small businesses to accept stablecoin payments, whether it's systems or it's some sort of SDK that allows them to easily switch between fiat currency to pay their taxes and whatever, and stablecoin payments from their clients, the accounting mechanisms that these companies will do, like triple entry bookkeeping and those sorts of things. So I think that's a very investable area in the stablecoin space. So the high level is, how does Trump and his boy Besson, Buffalo Bill Besson, get from where they are today, where he controls the Treasury, to where they need to go, which is the Treasury and the central bank, the U.S. Federal Reserve, are working together to print money to accomplish their economic policies. And so this is an essay basically talking about the minutia of how votes happen and how many people you need to have on which board to do what things, and this bureaucratic quagmire that Trump is going to try to pack his people on there so that he gets the policies that he wants. So I mean, if you listen to the rhetoric from both people, Besson just wrote an op-ed in the Wall Street Journal about the Fed's policies. If you listen to Trump and all of his lieutenants, and what's the big thing that they care about? Well, they're really pissed off that the U.S. can't go and bomb everybody that they want to bomb without impunity, because they don't have any bombs. So they want to build more bombs, and so they need to have more companies building real things and not just, MBAs doing LBOs in New York. And so they need to print money and revitalize the American industry. Now, it's not that easy to do. And this is what they did during the war in World War II, right? They fixed the yield curve. And in the essay, I had a chart of the yield curve from 1942 to 1951. And the T-bill rate was fixed at 0.675%, like less than 1%. And then 10-year bonds forward were 2.5%. And so this was a yield curve that was very steep. It enabled a commercial bank to borrow from depositors cheaply, lend long, lend money to relevant industries to, juice supply and provide credit. And, politicians are not very imaginative. They say, oh, well, it worked during the war, then why can't it work now? And that's essentially what they're saying. And even if you listen to recent Fed board member Stephen Moran, he talks about the Fed's third mandate. And, relevant, interesting people on Twitter posted the quote from the actual Federal Reserve Act of 1913, and it basically said the Fed is responsible for ensuring a moderate rate of government interest on its bonds. What does moderate mean? Whatever the politicians want it to mean. And so, by law, the Fed is allowed to print infinite amounts of money to make sure the government can afford to borrow. And so why not do it now?
Unfolding across markets is a quiet but profound shift in how people view money, safety, and opportunity. Over the past decade and a half, one asset has outpaced traditional stores of value and challenged assumptions about what it means to hedge against economic turbulence. What once seemed like a speculative experiment has become a global benchmark, forcing investors and policymakers alike to reassess their strategies. At the same time, the role of digital dollars is expanding in ways that bypass the old gatekeepers. For much of the developing world, the appetite isn't for experimental local tokens but for direct access to a currency that still anchors global trade and trust. That convergence between a fast-rising alternative like Bitcoin and the persistent pull of the dollar defines today's financial crossroads. The real tension is not about technology but about distribution, reach, and the pace at which systems adapt to shifting demands. As traditional structures strain under debt, inflation, and technological upheaval, patience and positioning may prove more decisive than prediction. The tools now available are unlike anything previous generations could access during past upheavals, and the stakes are far larger given the scale of interconnected markets. What comes next may not be decided by price charts alone but by how people choose between scarcity-driven assets and state-backed currencies digitized for mass adoption. Will the next era of global finance be written by those who master scarcity or by those who perfect distribution? So stay tuned. If you're into real, data-backed takes on the financial system, hit like and subscribe so you don't miss the weekly updates. Thank you for the support and I hope you enjoy the video.